Welcome to Smart Dollar Mindset, your go-to place for mastering money, mindset, and smart investing. Today, we're diving into the investment philosophy of one of the most legendary investors in history, Warren Buffett. He built Berkshire Hathaway into a global empire, with billions in assets, by following a few simple but powerful rules. These aren't gimmicks. They are long-term strategies based on logic, discipline, and patience. Let's break down Warren Buffett's 12 principles and rules for investing, with real-life examples you can apply right away. 1. Rule number 1. Never lose money. Buffett's most famous rule is simple: don't lose money. His second rule? Never forget rule number 1. He understands that true wealth is built over time, and by prioritizing stability, he minimizes risks associated with volatile markets, ensuring his portfolio remains robust through various economic cycles. He believes that research and patience lead to success. In doing so, he not only shields his investments but also cultivates a sense of confidence, knowing that he is aligned with sound financial principles. This steadfast approach ultimately paves the way for sustained growth amidst uncertainties in the marketplace. Buffett never chased tech stocks during the dot-com bubble. While others were getting rich overnight, he waited. When the bubble burst, he avoided the massive losses most investors suffered. 2. Invest in what you understand. Buffett only invests in businesses he truly understands: what they do, how they make money, and what could threaten them. He famously avoided investing in tech companies for years because he didn't understand them. But he invested heavily in Coca-Cola, a company he understood deeply, and that paid off enormously. If you can't explain the business in one sentence, Buffett says you probably shouldn't invest in it. 3. Look for companies with economic moats. An economic moat is a sustainable competitive advantage, something that protects a business from its competition. Coca-Cola's brand loyalty and distribution network make it nearly impossible to replicate. Apple, which Buffett eventually invested in, has a loyal ecosystem and high customer retention. He looks for businesses with strong brands, high barriers to entry, or cost advantages. 4. Be fearful when others are greedy, and greedy when others are fearful. This is Buffett's advice for thriving during market volatility. When the crowd panics, that's when Buffett often buys. During the 2008 financial crisis, Buffett invested $5 billion in Goldman Sachs. While the world was in chaos, he negotiated favorable terms and made billions as the market recovered. 5. Invest for the long term. Buffett's favorite holding period is forever. He doesn't try to time the market. He buys quality companies and holds them. He's held shares of Coca-Cola for over 3 decades. Even through ups and downs, the compounding of dividends and growth paid off tremendously. His strategy depends on patience and thorough research, allowing for sustainable growth. By concentrating on steady, dependable investments, he creates a lasting portfolio that withstands market fluctuations. This method not only safeguards against impulsive decisions but also fosters a sense of security and longevity in his financial endeavors, affirming his belief in the importance of time over timing. 6. Buy wonderful companies at fair prices. Buffett used to focus heavily on buying cheap companies, but later shifted to buying great companies at fair prices. He paid a fair price for Apple, which wasn't a bargain at the time, but the company's quality, growth, and dominance made it a worthwhile investment. He believes in identifying long-term growth potential. He emphasizes patience. By leveraging a disciplined approach, he successfully mitigates risks while maximizing returns, illustrating that a balanced strategy can yield fruitful investments. Ultimately, his philosophy reflects a commitment to enduring prosperity and a trust in the fundamentals of solid companies. 7. Keep cash on hand. Buffett always maintains a strong cash reserve. It gives him the flexibility to buy when others are selling. During market crashes, most investors are illiquid. Buffett, with billions in cash, swoops in and buys valuable assets at a discount. Cash isn't just for safety, it's for opportunity. 8. Avoid debt and leverage. Buffett has always been cautious with debt. He believes debt can magnify returns, but it also magnifies risk. He's avoided high-leverage businesses and has kept Berkshire Hathaway virtually debt-free. While others use margin or loans to invest, Buffett stays grounded. This protects him during downturns and crises. 9. Invest in management you trust. Buffett doesn't just invest in businesses. He invests in the people running them. He looks for honesty, transparency, and smart capital allocation. Buffett has always spoken highly of people like Jeff Bezos and Tim Cook. He wants leaders who think like owners, not just hired executives. Great businesses can fail under poor management. Buffett avoids that risk. 10. Focus on return on equity, not earnings per share. Buffett looks at how efficiently a company uses its capital to generate profits, measured by return on equity, ROE. A company might have huge earnings but also massive capital. Buffett looks for companies that generate high returns from the capital they have. He avoids flashy numbers and focuses on efficient performance. 11. Don't follow the crowd. Buffett has never been afraid to go against the tide. He's often out of sync with market trends, and that's where he finds success. While investors were chasing tech IPOs in the 1990s, Buffett sat on the sidelines. He didn't jump on Bitcoin or meme stocks either. Instead, he waited for value. Independent thinking is his edge. 12. Stay rational and patient. Perhaps Buffett's greatest strength is emotional discipline. He doesn't get caught up in hype, fear, or greed. Through crashes, booms, bubbles, and corrections, Buffett has remained calm. His returns reflect not only his intellect, but his temperament. He waits for the right pitch, then swings hard. Warren Buffett's investing rules aren't flashy. They aren't trendy. But they work. If you want to build real wealth, slow, steady, and lasting, these 12 principles are your foundation. Start with 1 or 2. Apply them with discipline. Over time, you'll become the kind of investor Buffett would respect. Thanks for watching at Smart Dollar Mindset. Don't forget to like, subscribe, and share this with someone serious about financial freedom. We'll see you in the next one.